So imagine looking down at your phone, right, just a few years ago. You probably had these two really simple, almost gamified apps sitting right next to each other on your home screen.
Oh, yeah, the classic retail setup.
Exactly. One was for buying fractions of a Bitcoin, where you tap a button and watch like virtual confetti explode on the screen. And the other was for trading meme stocks with zero fees.
Right, checking the ticker on your lunch break.
Yeah. Well, the rest of the internet cheered on some massive short squeeze. I mean, at the time, they were essentially just consumer tech products, toys almost, in the eyes of the traditional Wall Street elite.
They definitely weren't taken seriously by the institutions back then.
Not at all. But now, fast forward with me to the middle of 2026. What happens when those two simple apps morph and adapt and weave themselves so deeply into the underlying infrastructure of the global economy that they basically become the very plumbing of the financial system?
I mean, what you're describing is really the maturation phase of an entire industry. It's this massive transition from uh, retail speculation, like the arcade era, if you will, to vital, highly regulated institutional infrastructure.
And that is exactly the mission of our deep dive today.
Really?
We are unpacking two massive, exhaustive Q2 2026 equity research reports. One is on Coinbase, ticker symbol COEIN, and the other is on Robinhood, ticker symbol HOOD.
Two companies that have just completely transformed.
Completely. We are going to look way past the sensational daily stock movements, ignore all that headline noise, and dig straight into their 10-year financial metrics. We'll examine their underlying cash flows and evaluate them through this incredibly strict lens of deep value investing.
Which is a tough test for tech companies.
Oh, brutal. But we need to see if beneath the whole tech bro veneer, these are actually fundamentally sound businesses. But before we jump into the deep end, I do need to share this with you. To access more advanced researches, applications, and our latest Deep Values agents, welcome to explore and join Deep Values app. Track total market temperature, welcome to search and download iOS app Buffett Indicator from Apple App Store or Bubble Watch from Google Play. Disclaimer, all analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for research and entertainment purposes only and does not constitute any investment or financial advice or service. Conduct your own due diligence before making investment financial decisions.
Good to get the housekeeping out of the way.
For sure. Okay, with that on the record, let's get into it with our resident financial architect. The Q2 2026 earnings just hit Wall Street. And, I mean, they painted two completely different, almost contradictory pictures.
Yeah, the divergence in the after-hours market reaction was just striking. If you were only looking at the surface-level trading data, you would honestly assume these two companies were operating in entirely different macroeconomic universes.
Right. So let's start with the immediate shocker, which was Coinbase. Because on paper, this looked absolutely brutal.
It really did.
So for the second quarter of 2026, Coinbase's revenue fell 19% year over year to $1.22 billion. Wall Street analysts had penciled in, somewhere between $1.3 and $1.35 billion, so they missed the mark cleanly.
A pretty significant top-line miss.
Yeah, and total crypto trading volume across the industry dropped 15%, with spot flows down nearly 25%. But the absolute kicker, under generally accepted accounting principles, or GAAP, they posted a net loss of $359 million.
Ouch.
Right? That's a negative $1.36 earnings per share, massively missing the expectation of a positive 15 cents. So, unsurprisingly, the stock just plunged over 6.5% after hours.
And, the initial sell-off totally makes sense if you view the company through a legacy lens. I mean, the algorithms and short-term momentum traders see a top-line miss and a severe GAAP net loss, and the immediate programmed response is just to hit the bid and sell.
Right, they just dump it.
Mhm.
But then you look at the other side of the coin with Robinhood, and it's an absolute boom. Robinhood's Q2 2026 revenue hit an all-time record of $1.31 billion,
Which is incredible growth.
up 32% year over year. Net income spiked 48% to $573 million, translating to 62 cents per share. Looking at these two reports side by side, it feels like Coinbase is this city desperately trying to build a massive underground plumbing system, but a hurricane is sitting right over them.
That's a great way to put it.
Like the concrete is being poured, the pipes are being laid, but the weather's just terrible, so nobody is outside. Meanwhile, Robinhood feels less like an arcade and more like a casino that just opened a highly lucrative amusement park next door, and they have perfect sunshine.
The plumbing versus amusement park analogy, I mean, that highlights the current divergence in their user bases perfectly. Because the weather you are referring to is really the cyclical nature of digital asset velocity.
Right, how fast the money is moving.
Exactly. Coinbase's primary headwind in Q2 wasn't that users were abandoning their platform for competitors. It was a broader, global macroeconomic slowdown in crypto volatility.
People just weren't trading.
Yeah, when digital asset prices just chop sideways for months on end, retail traders simply trade less. The velocity of money in the space ground to an absolute halt.
But see, there is a glaring contradiction in the research that I really need help wrapping my head around. I'm reading the source material here, and it says Coinbase hit an all-time high of 10.3% global crypto spot trading market share in Q2.
Yep, they did.
That's up from 9.1% in Q1. This is their third consecutive quarter of taking market share from competitors. So how can a company be bleeding $359 million if they are capturing a larger piece of the global pie than ever before?
And that paradox right there is the most important takeaway from the entire Coinbase report. To understand it, we have to separate GAAP accounting rules from actual physical cash generation.
Okay, lay it on me.
So the 10.3% market share growth represents a massive flight to quality by institutional players. These guys require regulated, safe execution, so structurally the underlying business is winning.
They're getting all the big fish.
Right. But the reason they posted a $359 million GAAP loss really comes down to how accountants are forced to treat digital asset mark-to-market valuations alongside these massive legal expenditures fighting the SEC and a huge chunk of stock-based compensation, which is a non-cash expense.
Let me stop you there for a second, because the mark-to-market accounting for crypto always trips people up. If I buy a house for $500,000 and the housing market dips so it's only worth $400,000 on Zillow, I don't report a $100,000 loss on my taxes unless I actually sell the house.
Exactly, you haven't realized the loss.
But with crypto on a corporate balance sheet, the rules are different, right?
They are now, yeah. The Financial Accounting Standards Board, the FASB, recently updated the rules for digital assets. Because companies hold crypto assets for various reasons, sometimes for investment, sometimes just to facilitate customer operations.
Right, keeping the pipes full.
Exactly. But under the new fair value accounting rules, companies have to measure those crypto assets at their exact market price at the end of every single reporting period.
Oh, wow. So no matter what, they have to reevaluate it.
Yes. So if the price of Bitcoin drops at the very end of Q2, Coinbase has to record that paper loss on their income statement, even if they haven't sold a single token.
That's wild.
It creates these massive, wild swings in their net income that honestly have nothing to do with their actual operating business.
So that $359 million loss isn't cash actually going out the door.
A significant portion of it is absolutely not cash. If you strip away the paper losses, the legal fees, and the stock-based compensation to look at adjusted EBITDA, which is earnings before interest, taxes, depreciation, and amortization, Coinbase actually posted its 14th consecutive quarter of positive adjusted EBITDA.
Wait, really? 14 quarters?
Yep, it came in at $208 million for Q2.
Wow, so their 14th consecutive quarter stretches all the way back through the darkest days of the 2022 crypto winter.
It does. Following that 2022 market contraction, when major exchanges were imploding left and right and the industry felt like it was on the brink of extinction, Coinbase's executive team implemented incredibly austere variable cost management.
They just cut everything.
They slashed marketing budgets, they normalized their headcount, they renegotiated vendor contracts, and because their cost structure is so dialed in now, even in a quarter where overall market volume drops 15% and retail enthusiasm is just completely asleep, they still generate over $200 million in adjusted operating profitability.
So the market punished them for a temporary cyclical dip while missing the structural market share expansion entirely.
Exactly. They completely missed the forest for the trees.
Which means an earnings miss is just a snapshot, heavily distorted by the current weather, as we said. To understand the real story and calculate the intrinsic value of both of these companies, we have to look at how they have completely redesigned their original business models.
Right. They are not the same companies they were in 2021.
Not at all. If you still think Coinbase just makes money when people buy Bitcoin, or Robinhood just makes money when people trade GameStop, the research shows that is an incredibly outdated view.
The evolution of their revenue streams is just staggering. I mean, let's examine Coinbase's internal initiative, which they actually call the Everything Exchange.
Catchy.
Historically, their survival was hyper-reliant on Bitcoin volatility. But looking at the Q2 2026 data, non-Bitcoin trading represented 88% of their total net revenue.
88%. I mean, that is a near total decoupling from a singular reliance on Bitcoin's price action.
And the transformation goes much deeper than just, diversifying the altcoins people trade. Their subscription and services segment, so this includes non-trading, recurring, or asset-based revenue, it held completely steady at $555 million.
That's a huge chunk of change.
It's 48% of their total net revenue. Nearly half of their entire business now operates independently of whether the broader crypto market is going up, down, or completely sideways.
Okay, I really want to dig into that 48% because a massive chunk of that comes from USDC, the stablecoin. The research points out that the average USDC held in Coinbase products hit $20 billion.
It's a staggering figure.
They hold over 30% of all USDC in circulation globally, just sitting right there in their ecosystem.
And the mechanics of stablecoin revenue are brilliant, honestly, and they require a bit of unpacking to fully appreciate. So USDC is a digital dollar issued in partnership with a company called Circle.
Right.
For every digital USDC token circulating on the blockchain, there is a real US dollar, or like a highly liquid short-term treasury bill, sitting in a regulated bank account backing it up.
Which is how it keeps the peg at exactly $1. Like if I want to redeem my USDC, they have the physical fiat dollar waiting for me somewhere.
Exactly. Now consider the sheer scale of those reserves. You have tens of billions of real US dollars sitting in reserve bank accounts, and those accounts generate yield.
Right, just basic interest.
Because Coinbase is a founding partner in the Center Consortium that originally managed USDC, and they have this deeply integrated partnership with Circle, they have a revenue sharing agreement. Coinbase captures a massive portion of the interest generated by those fiat reserves.
So when short-term interest rates are hovering around, 4 or 5%, and you have $20 billion floating in your ecosystem, I mean, the math on that is staggering.
We're talking about roughly $1 billion a year in pure high-margin interest income that requires virtually no operational effort or marketing spend to maintain.
It just prints.
It acts as a massive financial shock absorber. They're operating much more like a traditional financial utility now, processing transactions and earning yield on deposits.
So they aren't just an exchange anymore.
No, not at all. Now, they will always have a high beta correlation to the crypto market, meaning if crypto crashes, their stock will likely drop too because trading fees still matter. But that $555 million from subscriptions and services effectively covers their baseline fixed operational costs before anyone even makes a single trade.
So they've built a fortress. But let's look at Robinhood, because their divergence here is wild. While Coinbase leaned heavily into institutional crypto infrastructure and stablecoin yield, Robinhood went in a completely different direction.
A total pivot.
Yeah, on Robinhood, crypto revenue actually dropped 38% in Q2, down to just $100 million.
Which perfectly illustrates the cyclicality we were just discussing. Retail crypto trading just dried up across the board for everyone.
But Robinhood's overall revenue hit a record $1.31 billion regardless. Their transaction revenue hit $776 million, making up almost 60% of their business.
And a massive chunk of that was driven by options trading, which came in at $342 million.
Right. But the data point that jumped off the page for me is something called event contracts. This category saw a 10x surge year over year, generating $156 million in a single quarter.
Yeah, both management teams realized that relying on the retail trading frenzy of standard equities or spot crypto is just a flawed long-term strategy. The engagement is way too fickle.
People get bored or they run out of money?
Exactly. So Robinhood realized that the profit margins, and more importantly, the daily user engagement, are substantially higher in derivatives and prediction markets.
So for someone listening who just buys like standard ETFs in a retirement account, let's explain what an event contract actually is, because $156 million in a single quarter is massive for a new product.
So an event contract is essentially a prediction market. Instead of buying a fractional share of a company and holding it for 5 years, you are trading a contract based on a specific binary outcome within a very defined time frame.
Like a yes or no question.
Exactly. Will the Federal Reserve cut rates by 25 basis points in September? Yes or no? Will the S&P 500 close above 5,500 on Friday? Yes or no? Will a specific economic data point come in hotter than expected?
It's all just binary.
Yep. The contract pays out a fixed amount if you are right, and it goes to zero if you are wrong.
I mean, that sounds remarkably similar to legalized sports betting, but applied to macroeconomic events.
Structurally, the mechanics mirror binary options perfectly. To facilitate this, Robinhood didn't just build a pretty front-end interface. They actually acquired a CFTC-licensed clearinghouse and integrated a joint venture called Rothera.
Oh, they own the back end too.
Right. This positioned them as the dominant clearing and execution force in retail prediction markets. And the velocity of trading here is what really drives the revenue. A user might buy an Apple stock and generate one single transaction fee or rebate in a decade.
Sure.
But that same user might trade 10 event contracts in a single week to hedge their portfolio or just speculate on the news cycle.
And Robinhood is collecting a fee on every single one of those rapid-fire transactions.
Right.
But beyond the transaction volume, Robinhood has a secondary engine that basically mirrors the stablecoin yield we talked about with Coinbase, right? Net interest revenue.
Yes.
It came in at $389 million, which is almost 30% of their total revenue.
The mechanics here essentially apply that stablecoin yield concept to traditional finance. Robinhood has 28.4 million funded customers. When those customers deposit money but don't immediately buy a stock or an event contract, that uninvested cash just sits in their accounts.
Just waiting to be deployed.
Robinhood sweeps those billions of dollars to partner banks and earns a yield on it. Furthermore, they operate a $19.5 billion margin book.
So margin lending is basically when the broker loans you money to buy more stock than you can actually afford using your existing portfolio as collateral.
Exactly, and they charge a premium interest rate for that loan. So between the yield on the cash sweeps and the interest collected from margin lending, Robinhood has essentially built a highly profitable mid-sized bank operating invisibly beneath their brokerage interface.
It's wild. We're looking at two companies that started with very narrow, retail-focused niches, and both have successfully built these diversified multi-engine revenue ecosystems.
It's a masterclass in pivoting.
But generating cash is only half the battle, right? You
Yeah.
build walls to protect it.
Yeah.
So let's examine the economic moats.
Let's do it.
Starting with Coinbase, the research highlights that their most significant intangible asset is regulatory and security trust. They have amassed over 80 global licenses. But the legal framework that really anchors this trust is Uniform Commercial Code, or UCC Article 8.
Yes, this is crucial.
The report states that because they operate under UCC Article 8, customer assets are bankruptcy remote. Let's translate what that actually means for a customer.
Okay, to truly understand the power of UCC Article 8, we have to look back at the catastrophic collapse of FTX in 2022.
An absolute mess.
The fundamental flaw in FTX's design was the commingling of funds. FTX took customer deposits and, illegally, used them for their own corporate trading, venture investments, and even real estate purchases.
Right, they treated customer money like a piggy bank.
So when a run on the bank happened and the exchange collapsed, the customers discovered they didn't actually own their crypto. They were classified as unsecured creditors in a messy, years-long bankruptcy proceeding.
The ultimate nightmare scenario for any investor. You log in and your money is just gone, tied up in court for a decade, maybe longer.
UCC Article 8 is a proactive legal framework that definitively categorizes the relationship between the custodian, in this case Coinbase, and the client.
Okay.
Under Article 8, the financial assets held by Coinbase for its customers are legally recognized as not being the property of Coinbase. They are held in a strictly segregated trust manner.
So if Coinbase were to make a series of terrible corporate decisions and go completely bankrupt tomorrow, their corporate creditors couldn't liquidate my Bitcoin to pay off Coinbase's debts.
Exactly. Your assets are bankruptcy remote from their general corporate creditors. The Bitcoin belongs entirely to you. Coinbase is merely the cryptographic key custodian providing the vault.
That is massive for institutional trust.
By embracing this strict legal architecture early on, Coinbase built an unassailable moat of trust. If you are a risk-averse institutional capital allocator, say a sovereign wealth fund, a state pension, or a major Wall Street hedge fund, your fiduciary duty prevents you from putting billions of dollars on an offshore, unregulated exchange.
You'd get fired or sued.
Both. You are structurally forced to use a compliant UCC Article 8 custodian.
That completely explains the 10.3% global market share. It creates a massive liquidity network effect. I mean, more institutional buyers and sellers mean tighter spreads, which attracts even more volume.
It's a flywheel.
But there is a technological side to their moat as well. The base layer 2 network. The research says this cultivates a captive developer ecosystem.
So the Ethereum blockchain, which serves as the foundational settlement layer for most decentralized finance, has a major scaling problem.
It gets clogged up.
Right. During peak usage, processing a transaction directly on Ethereum can be incredibly slow and cost $50 or $100 in gas fees. A layer 2 network, like Base, sits on top of Ethereum to solve this.
Okay, how does it do that?
It bundles thousands of individual transactions together, processes them instantly for fractions of a cent, and then settles the final cryptographic receipt on the main Ethereum blockchain.
I always think of layer 2s like a high-speed commuter train that bypasses city traffic, dropping everyone off at the main station at once.
That's a perfect analogy. So Coinbase decided to build their own layer 2 network, Base, because Coinbase already has tens of millions of verified funded users. Independent software developers desperately want to build applications on Base to access that user pool.
Obviously, you go where the users are.
When developers deploy decentralized apps on Base and users interact with them, Coinbase collects a tiny fee called a sequencer fee for processing the transaction. They have engineered an entire parallel financial operating system where they own the infrastructure and collect the tolls.
I hear that, but I want to push back on the consumer side of Coinbase's moat for a second.
Mm.
If I'm a retail investor just looking for Bitcoin exposure in 2026, aren't zero-fee ETFs going to eventually eat Coinbase's lunch?
It's a very common question.
I mean, why would I pay Coinbase a 1.5% or 2% retail transaction fee when I can just open my Vanguard or Fidelity app and buy the BlackRock Bitcoin ETF for zero commission? Doesn't that structural fee compression destroy the retail moat?
It is the primary bear thesis against Coinbase's retail business. And honestly, the logic is sound. Retail transaction fees are in a race to the bottom.
So they are in trouble there.
Well, no. The brilliance of their institutional moat completely neutralizes this threat. When you buy that zero-fee BlackRock iShares Bitcoin Trust ETF or the Franklin Templeton ETF in your traditional brokerage account, those Wall Street asset managers don't actually hold the underlying physical Bitcoin themselves.
Wait, really? So who holds it?
Coinbase does.
Seriously?
Following the regulatory approval of spot ETFs in the U.S., the vast majority of traditional asset managers selected Coinbase Custody Trust Company, CCTC, to securely hold their digital assets.
Oh, wow.
So if you trade retail on the Coinbase app, they make a high transaction fee. But if you leave their app to buy an ETF at Vanguard, the ETS provider pays Coinbase a recurring basis point custody fee to hold the asset, plus institutional execution fees whenever the ETF needs to buy more Bitcoin to meet demand.
Coinbase captures the economics of the trade regardless of where you execute it.
Exactly. They are the base layer of the entire system.
They win either way. I mean, that is the definition of an impenetrable moat. Now, looking at Robinhood's moat, the research points to extreme switching costs.
Yes, stickiness.
They have 4.8 million Robinhood Gold subscribers paying a monthly fee for premium tools, higher margin limits, and better yields. They have 28.4 million funded customers. But the mechanism that really anchors the capital to the platform is the IRA deposit match. They are giving users a 1% to 3% match on retirement deposits.
The psychology and the financial friction embedded in that product are incredibly sticky. If you transfer your legacy 401k or IRA into a Robinhood account to capture a 3% match, there are strict vesting periods.
They don't just give you free money to walk away with.
Right. You usually have to keep the funds on the platform for 5 years. If you try to leave prematurely, they claw back the matched funds.
Makes sense.
Furthermore, if you are utilizing their high-yield cash sweep, trading options with their specific mobile interface, and using the Robinhood Gold credit card, extracting your entire financial life from that ecosystem to move back to a clunky legacy broker becomes a tedious, costly endeavor.
They are vertically integrating your entire financial life.
Yeah.
And they are aggressively expanding beyond the retail day trader. The research mentions their acquisition of Trade PMR, which brings $50 billion in assets under management and gives Robinhood a massive foothold in the B2B registered investment advisor, or RIA, space.
Which is a highly calculated strategic pivot. Independent RIAs control massive amounts of generational wealth.
The big money.
By providing the custodial back-end technology for these financial advisors, Robinhood taps into a much stickier high-net-worth demographic. It perfectly balances out their younger, hyperactive retail user base with slow-moving, long-term capital.
And speaking of demographics, we have to talk about a specific product launch mentioned in the research that dramatically expanded their total addressable market. In 2026, Robinhood launched what they termed Trump accounts.
Yes, this was a major catalyst.
Now, real quick, before we analyze the data on this, we are looking at this strictly through the lens of financial metrics and product strategy. We are objectively reporting the sign-up metrics and the product architecture exactly as they are presented in the equity research. We are putting aside any political nomenclature to focus entirely on the financial impact this product had on Robinhood's deposit growth and user acquisition. We're not taking any political sides here.
Absolutely. Examining it purely as a financial instrument, the Trump account is described in the research as a treasury-backed, tax-advantaged account specifically engineered for minors, focused on long-term generational wealth building.
And the metrics are wild. The report states that this expanded Robinhood's total addressable market to include over 60 million eligible children. In just the first month of launch, they saw 7 million account signups and $1.5 billion in deposits.
From an execution standpoint, acquiring 7 million new users in 30 days is a staggering metric for any financial institution.
I mean, that's unprecedented.
It targets a demographic minors, managed by their parents, that inherently possesses a multi-decade investment horizon. The $1.5 billion in immediate deposits funnels directly into their net interest margin engine.
Right, more cash sweeps.
Exactly. It is a textbook example of locking in a user at the absolute beginning of their financial life cycle. It significantly increases the lifetime value of that customer while simultaneously raising the switching costs for the parents who actually manage the accounts.
You are basically ensuring that the next generation's very first experience with compounding interest happens on a Robinhood interface.
It's brilliant marketing and retention all rolled into one.
So we've established that both companies have built these massive, diversified fortresses with deep moats. But fortresses still have to deal with threats outside their walls.
They certainly do.
Let's move into the future frontier and the existential risks they face. Because the future they are building towards sounds both incredibly sci-fi and deeply legally complex.
The regulatory gray areas are huge right now.
We already touched on prediction markets and event contracts. But the real mind-bender for me in this research is the integration of AI. Robinhood is pioneering agentic trading. They are allowing accounts where AI agents can autonomously execute trading strategies via their API. And Coinbase is pushing what they call the on-chain agentic economy.
It's happening fast.
But handing your brokerage API keys to a robot sounds terrifying.
It represents a profound paradigm shift in market structure. For the entire history of capital markets, the primary limiting factors have been human cognition, emotional discipline, and execution speed. Agentic trading removes the human from the active loop entirely.
So how does it actually work in practice? Like, I'm just sitting at home, what do I do?
You, as the user, define the parameters. You tell the AI your risk tolerance, your macroeconomic thesis, your preferred asset classes, and your drawdown limit.
Okay, so setting the boundaries.
Right. You then authorize an autonomous AI agent to monitor the global markets 24/7 day. This agent can parse breaking news sentiment in milliseconds, analyze complex technical indicators across thousands of assets simultaneously, and execute microtrades across equities, options, or crypto without ever asking for your permission on a per-trade basis.
I mean, that sounds amazing if the AI is a genius, but here is my immediate concern. If I'm using Robinhood and I grant API access to a third-party AI agent, and that AI hallucinates.
It happens.
Right. Let's say it misreads a news headline about a company going bankrupt when they actually just launched a new product with a similar name. The AI panics and autonomously liquidates my entire portfolio at a massive loss in 3 seconds. Who is liable? Does Robinhood reverse the trades? Does the AI developer pay me back? That feels like an unprecedented compliance nightmare.
You have zeroed in on the exact frontier of financial regulation. The liability frameworks simply do not exist yet for autonomous fiduciary AI.
It's just the Wild West.
Robinhood and Coinbase are building the infrastructure, the API pipelines, to allow these agents to interact with the market. But the compliance risk shifts dramatically. Historically, regulators asked, did the broker execute the trade fairly?
Right.
Now the question becomes, is the broker responsible for the algorithmic logic of a third-party agent interacting with their system? It is a massive gray area of systemic risk.
And speaking of risks, the research lays out several existential threats that could derail both of these companies right now. The first one is macroeconomic interest rate cuts.
This is the big one.
We spent a lot of time talking about how Coinbase makes a fortune on USTC yields and Robinhood makes a fortune on their net interest margin from cash sweeps. If the Federal Reserve slashes interest rates aggressively to stimulate a slowing economy, that pure high-margin profit just evaporates, doesn't it?
It compresses significantly. The math is unavoidable. If the Fed cuts rates by 200 basis points, the yield Coinbase earns on its $20 billion fiat reserve backing USDC drops mathematically.
Because the bank isn't paying them as much interest.
Exactly. And the yield Robinhood earns on its $28 billion cash sweep drops. However, it operates as a dual-edged sword. Typically, when the Fed cuts rates, liquidity floods the market, and risk assets like growth stocks and crypto surge in value.
Aha, so people start trading more.
Right. This should theoretically boost their transaction revenue, acting as a natural counter-cyclical hedge to the falling interest revenue.
The natural hedge makes sense. But then we have the regulatory risks, which seem far more structurally terrifying. For Robinhood, the SEC is heavily scrutinizing payment for order flow, specifically looking at PFOF Rule 615.
The dreaded PFOF.
Let's break down what payment for order flow actually is under the hood and why the SEC is hovering over it.
Payment for order flow, or PFOF, is the lifeblood of the zero-commission trading model. When you tap buy on Robinhood for 100 shares of Apple, Robinhood doesn't actually route your order directly to the New York Stock Exchange.
Yeah.
No, they route your order to a high-frequency market maker, a firm like Citadel Securities or Virtue Financial.
Because the market maker is the entity actually facilitating the trade.
Correct. The market maker executes the trade, profiting off the microscopic spread between the bid price and the ask price. In exchange for routing the order to them instead of a competitor, the market maker pays Robinhood a tiny fraction of a penny for the privilege of handling your flow.
Now, on standard equities, that payment is very small. But the research points out that on options contracts, which, remember, are driving a massive portion of Robinhood's transaction revenue, the spread is wider, and the payment Robinhood receives is substantially higher.
Much higher.
So why does the SEC care if Robinhood makes money on the back end? Doesn't the customer still get zero commissions?
The SEC's concern, encapsulated in proposed rules like 615, centers on an inherent conflict of interest regarding best execution.
Okay, meaning what?
Is Robinhood routing your options order to the market maker that gives you, the customer, the best possible price improvement? Or are they routing it to the market maker that pays Robinhood the highest PFOF rebate?
Oh, I see.
If the SEC were to mandate strict retail order-by-order auctions or severely cap the amount of PFOF a broker can receive for options writing, Robinhood's core revenue engine would face permanent structural impairment.
That is a massive lingering cloud for Robinhood. But Coinbase has its own regulatory Godzilla to deal with, SEC v. Coinbase, and specifically the Howey test on secondary markets.
This is the big legal battle of the decade.
The SEC has essentially argued that almost all crypto tokens, besides Bitcoin and maybe Ethereum, are unregistered securities.
This is the existential binary threat for the entire U.S. crypto industry. The Howey test is a legal standard established by a 1946 Supreme Court case involving an orange grove in Florida.
Wait, an orange grove?
Yeah. The court had to decide what constitutes an investment contract and therefore falls under the jurisdiction of the SEC. The test has 4 prongs. Is there an investment of money in a common enterprise with a reasonable expectation of profits derived from the efforts of others?
And the SEC argues that when an altcoin team launches a token and Coinbase lists it on their exchange for retail users to buy, it perfectly matches the orange grove scenario.
Yes. The SEC argues that secondary market sales of these tokens on an exchange facilitate the trading of unregistered securities. If a federal judge definitively rules in favor of the SEC's interpretation, Coinbase could be legally forced to halt trading on a massive portion of its asset catalog.
That would be devastating.
It would cripple their retail transaction segment and force a complete restructuring of the U.S. digital asset ecosystem.
But the research notes that Coinbase is fighting this aggressively. They have secured an interlocutory appeal in the Second Circuit Court of Appeals. What does that mean?
An interlocutory appeal means that before the trial even concludes, a higher appellate court is stepping in to critically evaluate the core legal theory the SEC is using.
That sounds unusual.
It is. It suggests the courts recognize the immense legal ambiguity of applying a 1946 Orange Grove law to decentralized cryptographic networks.
There is also a potential legislative lifeline mentioned in the report, the Clarity Act. And again, just looking at this strictly as a legislative catalyst mentioned in the equity research, we are outlining its mechanics and the potential financial implications for Coinbase's business model. We aren't endorsing it or taking any political sides.
Objectively speaking, the Clarity Act is described in the research as a legislative tailwind seeking to provide a formal statutory pathway for digital assets in the United States.
So, writing new laws instead of using old ones.
Exactly. The core mechanism of the Act is to allow digital assets to transition from being classified as securities under the SEC to being classified as commodities regulated by the CFTC once the underlying blockchain network achieves a certain threshold of decentralized maturity.
Okay, let me make sure I have this right. If a project starts out highly centralized, like a small startup team controlling the code and the treasury, it might correctly be classified as a security.
Right.
But if it grows, decentralizes, and no single group controls it anymore, like Bitcoin, it basically graduates to being a commodity, which falls under a much lighter regulatory framework.
The transition mechanism is the key. If such legislation were to pass, it would effectively neutralize the SEC's Howey test argument for mature tokens, entirely removing the existential regulatory overhang for Coinbase. It serves as a potent structural hedge against the current enforcement actions.
We have deeply analyzed the business models, the moats, and the terrifying risks. Now let's get to the actual numbers. The research takes both of these modern AI-driven crypto-adjacent tech companies and slams them against the wall of traditional old-school Graham and Dodd deep value investing metrics.
It's quite a stress test.
We are talking about a Python script analyzing 10 years of data from 2016 to the trailing 12 months of 2026.
It is an incredibly demanding framework. Deep value investing, classically defined by Benjamin Graham in the 1930s, seeks asymmetrical risk-to-reward profiles by demanding a mathematical margin of safety, tangible asset backing, and ironclad earnings predictability.
The complete opposite of a hyper-growth tech startup.
Exactly. These are metrics that hypergrowth, cyclical technology companies inherently struggle to meet.
And struggle they did. Let's look at the scoreboard for Coinbase. First, the price to earnings, or PE ratio. They fail.
It is currently negative because of the JAP net losses we discussed earlier.
Right. Next, they fail the PEG ratio.
Because their earnings growth is just too volatile to chart a smooth, predictable trajectory.
They fail the price-to-book ratio. It sits at 2.92x, which is way above the traditional deep value threshold of 1.5x.
However, the data shows they pass spectacularly in two specific operating metrics. Their gross margin consistently operates around 80%, which showcases the ultimate software-like scalability of an automated matching engine.
Because it cost them virtually nothing to facilitate one additional trade.
Right, and their free cash flow margin was a robust 17.94% in the 2026 trailing 12-month period.
They generate massive cash, but fail the traditional valuation multiples. What about Robinhood? They fail PE. It's at 43.5x, meaning the market is paying a massive premium for future growth.
True.
They fail price to book, a massive 8.54x premium to their net assets.
Yep.
And they fail the 10-year return on equity average.
Well, that's almost entirely because of the billions of dollars they lost in their early hypergrowth startup phase before they flipped to profitability in 2024.
But again, look at the cash generation.
Well,
Robinhood's free cash flow margin is a staggering 60.2%.
it's massive, and they have $10 billion in unencumbered net cash just sitting on their balance sheet.
Now, there is one deep value metric where both companies fail, but the research points out it's actually an accounting illusion. Return on assets, or ROA. Both failed to hit the required 6% deep value threshold. Walk me through why this specific metric is distorted.
Return on assets calculates how efficiently a corporate management team uses its assets to generate profit. The basic formula is net income divided by total assets.
Okay, pretty straightforward.
But for brokerages and custodians like Coinbase and Robinhood, the SEC requires them to list customer custodial funds as an on-balance sheet liability and simultaneously list the corresponding segregated cash or crypto as an on-balance sheet asset.
Let me see if I have this right. When Robinhood takes in $1.5 billion in deposits from those Trump accounts we talked about, their total assets artificially bloat by $1.5 billion, even though that isn't Robinhood's corporate money to spend or invest.
You have the mechanics perfectly. This regulatory accounting requirement artificially inflates the denominator in the ROA calculation.
Screwing up the math.
By adding tens of billions of customer dollars to the asset side, it mathematically suppresses the ratio below the 6% threshold in almost all years. If you strip out customer custodial assets and only look at their actual corporate assets, their efficiency metrics improve dramatically.
But there is one very real problem dragging down GAAP profitability specifically for Coinbase. And it's not an accounting illusion. The biggest enemy to their intrinsic value isn't a competitor. It's internal dilution from stock-based compensation, or SBC.
Yeah, this is a real issue.
The report notes it frequently exceeds $200 million per quarter.
This is the silent killer of shareholder value in the modern technology sector. To recruit and retain elite cryptography engineers and blockchain developers in a highly competitive market, Coinbase issues massive amounts of restricted stock units.
So they have to pay top dollar for talent.
Exactly. While this is a non-cash expense, meaning it doesn't drain their bank account, which is why their free cash flow remains so high, it constantly increases the total number of shares outstanding.
It's like having a pizza where the size of the pizza never changes, but management keeps cutting it into more and more slices. Every individual slice gets smaller and less valuable.
Great analogy.
The research notes that until executive management demonstrates aggressive discipline in share count containment, upside equity momentum will continually face severe gravity. Contrast that with Robinhood. They had terrible SBC dilution problems around their IPO in 2021, but now the board authorized and is currently executing a massive $1.5 billion share buyback program.
A share buyback is the exact opposite of the SBC dilution problem. Robinhood is using their mountain of free cash flow to buy their own shares on the open market and retire them.
Shrinking the float.
By shrinking the total float of available shares, every remaining share claims a larger percentage of the company's future earnings. It mechanically boosts earnings per share even if net income stays flat. It is a hallmark of cash-generative discipline that fundamentally separates the mature 2026 Robinhood from its historical startup profile.
So if neither of these companies passes the traditional deep value test, they fail PE, they fail price to book, they fail 10-year predictability, I have to ask, are Benjamin Graham's rules just obsolete in a world of software, zero marginal costs, and AI? Or are these stocks simply wildly overpriced?
Deep value isn't dead, but its application definitely requires context. If you rigidly demand a price to book under 1.5, you will almost exclusively buy distressed industrial companies, legacy banks, and dying retailers.
Right. You'll completely miss the digital revolution.
What the research suggests is that you have to shift the lens from classical asset-based deep value to cash flow value. You have to evaluate the operating leverage. Robinhood's 60.2% free cash flow margin is absurdly good.
Because it's all digital.
Exactly. They don't have to build physical factories, pour concrete, or buy steel to double their revenue. They just need more server space. Therefore, they fit cleanly into a GARP framework growth at a reasonable price. They command a premium valuation because their underlying cash compounding engine is so powerful.
Which perfectly sets the stage for the final analysis, the discounted cash flow scenarios, and the final verdict. Now, for the listener who might not build financial models on the weekend, a discounted cash flow, or DCF, is basically a way to figure out what a company is intrinsically worth today based on all the cash it is projected to generate in the future.
That's right. Because a dollar today is worth more than a dollar 10 years from now due to inflation and opportunity cost. So we project the future cash flows of the business and discount them back to their present value using a specific interest rate, known as the weighted average cost of capital.
And the research strictly enforces a 30% margin of safety on these DCF buy prices. Let's make sure we are crystal clear on what that actually means in practice.
A margin of safety is fundamentally an admission of human ignorance. We cannot perfectly predict the future.
No one can.
Our growth assumptions might be wrong, regulations might change, competitors might emerge. A 30% margin of safety simply means that if our rigorous DCF model calculates the absolute intrinsic value of a stock to be $100, we refuse to buy it for more than $70. We are buying a dollar for 70 cents.
Leaving room for error.
That 30-cent buffer protects our capital if a recession hits or if our growth estimates were simply too optimistic.
Okay, let's look at the Coinbase DCF models based on their normalized free cash flows. The no growth case. Assuming the crypto market stagnates forever, the intrinsic value is roughly $134. With a 30% margin of safety, the buy price is $94.42.
Got it.
The conservative case. Assuming modest 3% growth, the intrinsic value is $159. With the margin of safety, the buy price is $111.72. The nominal case. Assuming 12% growth driven by global tokenization and the on-chain economy, intrinsic value is $278.37. The buy price with a margin of safety is $194.86. Now, where is the stock trading right now? $163.55.
The market pricing is fascinating. At $163.55, Coinbase is trading almost exactly at its conservative intrinsic value of $159 without any margin of safety applied.
Right.
It means the market has priced in the conservative case perfectly. Therefore, as a value investor demanding a 30% discount, $163 is not a deep value entry point. You would only deploy capital here if you possess supreme, unshakable conviction that the nominal 12% secular growth trajectory is going to materialize. You are paying for the growth upfront.
What about the Robinhood DCF? No growth case buy price, $39.53. Conservative case buy price, $57.80. Nominal case, assuming 15% historical normalized growth, intrinsic value is $141.46. Buy price with a 30% margin of safety is $99.02. Current stock price, $92.62.
So Robinhood is trading well above its conservative intrinsic value and right around the nominal buy target. The market is pricing in sustained double-digit growth. It is priced for near perfection.
If we synthesize this data, the research points out that thematic growth managers, specifically Cathie Wood's ARK Invest, have historically played both of these stocks perfectly by understanding this valuation dynamic.
They've timed it incredibly well.
ARK doesn't wait for a clean, deep value PE ratio. They utilize value averaging during periods of maximum distress. They bought massive tranches of Coinbase under $50 in 2022 when regulatory pessimism peaked, and they trimmed heavily when retail euphoria pushed it over $250.
Buy the regulatory fear, sell the retail greed. Because the secret alpha for both of these companies right now isn't just user growth, it is what the research terms regulatory alpha.
Regulatory alpha. I love that concept.
It means that whichever company survives the current onslaught of SEC scrutiny, whether through litigation victories in the appellate courts or legislative changes like the Clarity Act, emerges with an impenetrable monopoly.
They just own the space.
Traditional banks are paralyzed by the legal ambiguity of digital assets and event contracts. If Coinbase and Robinhood secure definitive regulatory clarity, they will have already built the entire compliant infrastructure. They will be the only viable pipelines for trillions of dollars of institutional capital waiting to enter the space.
And that brings us to the end of our journey today. Let's recap what we just unpacked. We started by looking at what most people assume are just two volatile, gamified retail trading apps.
Just toys on a phone.
But by digging deep into the exhaustive 10-year equity research, stripping away the gap accounting noise, and looking at the actual cash flows, we revealed something completely different. These are no longer pure-play brokerages reliant on retail frenzy. They are diversified, highly profitable, cash-generating fortresses.
They've really grown up.
They have built massive economic moats, supported by recurring subscription revenues, stablecoin yields, complex derivatives, and deep B2B integrations with wealth managers. While they might fail the rigid test of a 1950s asset-based value investor, they exhibit the hyperscalable operating leverage of the next generation of financial infrastructure.
They are the digital plumbing of the future economy, and their current valuations reflect a market that fully expects them to survive the regulatory gauntlet and monopolize that future.
But I want to leave you, the listener, with one final provocative thought to mull over, building on what we discussed regarding AI. Think about this. Robinhood is actively opening its API doors to agentic trading. Coinbase is aggressively building the infrastructure for the on-chain agentic economy.
It's coming faster than we think.
We are moving toward a world where the vast majority of transaction volume won't be driven by you and me tapping buttons on our phones. It will be driven by autonomous AI bots, executing thousands of deeply complex trades every second based on instantaneous data parsing. If AI algorithms become the primary volume drivers of these platforms, the everything exchange of tomorrow won't just be built for humans.
That's a wild thought.
So what happens to the human retail trader? Are we just going to end up as slow-moving, inefficient liquidity providers for an army of algorithms? Something to mull over next time you open your portfolio. Thank you for joining us on this deep dive. Keep questioning the numbers behind the headlines. Always check the accounting, and we will see you next time.